Thanks for joining us here on Morning Markets. I'm John Ehrlichman in for Paul Bagnall. And in the markets today, we've got some interesting dynamics playing out. After the recent weakness in Toronto, investors coming back to the Canadian market. A little less so, though, in New York, where the S&P is higher, but the NASDAQ is not. And after that huge run-up that we saw recently in AI darling NVIDIA, it seems investors are quickly taking some money off the table. Now, of course, these big AI tech leaders have been providing a lot of the profit muscle. So there is going to continue to be a long-term question about how investors should be positioned over the long term. But did we move too far, too fast? We want to bring in our featured guest this hour, Gavin Graham, to talk more about this. He's a contributing editor with the Income Investor newsletter, as well as the Internet Wealth Builder newsletter. Great to have you back with us, Gavin.
Good to be here, John.
Okay, so first of all, what do you make of where we're at? A year where tech surges, Canada lags, but now it feels like maybe there's some short-term jitters. What's your assessment?
Well, there should be some jitters, not merely short-term jitters, because you had the Magnificent Seven, although apparently it's shrinking a little bit these days. I mean, Tesla is down, Apple was down before it came out with its AI announcement, and it's been so narrow and so dependent on those large cap tech stocks, particularly the AI ones like NVIDIA, which you were mentioning, that any weakness in those has to be a source of concern. And of course, NVIDIA just did that very important thing, which is to split its stock. And you might remember, John, back in the days of the tech bubble in 1999-2000, I think there was even a mutual fund set up to buy stocks which announced they're going to split because it made the price go up. And indeed it did, but of course it has no effect at all on the actual underlying fundamentals, which is it's pretty expensive. AI is important. AI is going to make a major contribution. NVIDIA has been obviously the major beneficiary, but at some point the competition is going to come into the market and its margins will get eroded and the share price will probably have a little bit of a dip, like it did in 2022, you might remember, where it actually was off something like 30-40%. So it's understandable that people ought to be a little nervous about these jitters because they are a precursor maybe of things changing.
What about the profit story? Because, Gavin, I've heard that endlessly during this NVIDIA run. When you look at the stock run up and then you compare the earnings growth, which is remarkable, that it makes the company's valuation look much more respectable. How, as an investor, have you approached that dynamic over the years?
Well, I'm extremely bad at estimating what tech companies are worth. So I'm not really the person to be asking. All one can say is that if something is growing as fast as NVIDIA's profit has been, because it's been in exactly the right place at the right time with almost no competition, eventually it's going to slow down. The law of large numbers means you cannot keep growing at that rate, especially as there's enormous profit margins and growth is going to attract competition into that sector. And we've seen this picture before, John, whether it was 1999-2000, whether it was the Nifty 50 in the early 70s, you are going to actually see a derating of these stocks at some point. And indeed in 2022, just to revert back to that momentarily, because you had interest rates going from 0.25% to 5.25%, that put a very big crimp in long duration assets where a lot of the value you're paying for is down the road because obviously the cost of capital has gone up a lot.
Now, you mentioned interest rates. I want to take the conversation there next. The Bank of Canada has already cut interest rates for the first time in 4 years. This week, we'll get some inflation numbers, which could feed into the idea of the bank continuing down that path. Tie together the stories of interest rates and the stock market and what you're going to be watching in the months ahead.
Well, I think the most important thing, John, is that the Bank of Canada has become the first G7 central bank to cut interest rates. And once they start moving in one direction, they keep moving, as they did on the way up. You had the ECB cutting, you've had Bank of Switzerland cutting. You are starting to see a major move on the part of central banks going, we got on top of inflation. Maybe it won't get back down to our 2% target, but we're now, you have some really attractive real interest rates with interest rates at 4 3/4 or 5.25% and inflation around 2. You're getting a pretty decent real return. And that is going to be good news for the interest rate sectors like, for example, the banks, pipelines, utilities, REITs, telecoms, all of which have lagged fairly badly because they had a lot of debt, even though most of it was fixed rate, and they had some pricing power. But nonetheless, when interest rates rise, interest rate sensitive sectors go down. That should now start to reverse. At the same time, it looks like it's going to be higher for longer. So even though rates have started to come down, one, maybe two cuts from the Federal Reserve this year, maybe the Bank of Canada, having moved ahead, will actually now cut further than that, but it's still going to be higher for longer.